Hi, good evening, everyone. Welcome all the investors to the quarterly webinar for the Kotak Discretionary Solutions. I'll first introduce Ms. Lakshmi Iyer. She is CEO, Investment Advisory and Strategy at Kotak Alternate Asset Managers Limited. Over to you, Lakshmi, to start the webinar.
Thanks, Nishant. Hi, and a very good evening to each one of you. It is definitely a better day today from a market standpoint. We have asset classes, both equity and gold, which are sizzling, and even fixed income is not showing any signs of fizzling out. So I think it's overall a very happy situation. But I'd say that, the market phase can be split into two phases. One is the tariff pause, or I would say the post-tariff pause phase, which is actually leading to this kind of an applause. And one is the pre-tariff phase, where the markets were anyways looking to, have some sort of semblance or situation where it was looking to consolidate. The tariff just acted as a very strong catalyst, and the ripple effects of that obviously was being felt till the time we saw the tariff pause. And why it's important to spend, a couple of minutes on that is not because from a bilateral trade perspective, but more importantly, when things like this happen, the foreign investors actually go into a groove or a snail mode, because obviously it's the mother of all economies, which is leading this entire I would say the fatwa or the directive, or as the case may be. And more importantly, at that point in time, it's only two asset classes which inspire a lot of confidence. One is gold and the second is dollar. Now, if you dissect, you'll realize why dollar has not really played out its sheen this point in time, because the entire origination of this catalyst or crisis kind of a scenario was led by the US, which obviously controls the world's reserve currency, which is a dollar. And it also came at a time where the retaliating party was actually China. Among other nations, it was China. Now, if you look at the largest holders of US treasuries, it is actually Japan, followed by China. And that is the reason this reciprocal tariff is leading to much more heartburns between China and the US. And in that process, China is actually selling US treasuries. And in that process, obviously, we are seeing dollar weaken. So I think, therefore, this is a slightly unique situation compared to the situations that we have seen in the past. In such a long time. For example, the kind of meltdown that we saw in Dow yesterday is the worst April, or almost the worst April, assuming this is how we extrapolate April. We are we have a few more trading days to go, but clearly since the Great Depression, this is one of the worst Aprils that the Dow as an index has seen. So therefore, narratives change, things change. We do have a pause. So how much more can we applaud is something that time will tell. But I think after 11 consecutive days of selling Indian equities, the FPI sentiment, at least for the near term, has turned positive. They've been pumping in, they've been net buyers. Mutual funds, of course, never stopped their buying spree. They kept oscillating between low cash to lower cash, and they were deploying cash in this rally. Is it going to be a short-term rally? Is it going to be slightly more long-drawn? Are we at the bottom? I would say the answer lies somewhere in between, because compared to US, we are cheaper in terms of valuation, and but compared to China, we are more expensive. So that's the reason we are perched right in the center. But having said that, are we reaching closer towards the corrective phase being over compared to the euphoria phase being there? I would say we will bet for the former. And I think that is exactly how we are going about constructing our portfolios, including our iconic, which Nishant will take you through in some time. But long story short, you are going to see these kind of oscillations in the market. You require a platform which gives you a taste of multiple strategies into one roof, and also allows you to complement active versus passive. I'm sure Nishant would have this as part of his presentation, which actually shows you how there is a cyclicality, not just in sectors, but there is cyclicality in market caps, and there is a cyclicality within market caps also. So I think given all that, you require a one-stop shop sort of a solution, which allows you to try to nuance all of these in bundled into one strategy. And that's exactly how we intend, and that's how we have been positioning our offering in the market. Happy to say that, up until now, of course, CY 2025 is just the fourth month. We don't want to get excessively disappointed or dissuaded by the small underperformance over the benchmark that we've had in the last quarter or so. But having said that, if you look at the longer track record of the fund versus the benchmark, that still remains intact. And given the fact that we've navigated such a difficult market up until now, I think one of the most gyrating markets, given the fact that we do not know what the next move from the US is going to be. So I think all in all, it's been a happy journey up until now, thanks to the support from all of you as investors, as stakeholders, as channel partners. So I think that's where the market mood and sentiment is. Are we completely out of the woods? Well, probably not. But as I said, we are just about getting there, because in a market scenario like this, I think one thing is certain, which I've seen across 2.5 decades of investments, is that the risk premium, the equity risk premium for emerging markets tend to recede or come down. And therefore, India definitely lies in a sweet spot. So I will pause here. Thank you so much. I will ask Nishant to now take you through the strategy in greater nuance and detail. Over to you, Nishant.
Thanks, Lakshmi, for those insights on the current market situation. To delve further in terms of how the strategy is navigated over the last quarter. To begin with, let's look at in terms of what the discretionary solutions intend to solve. A quick recap. What we intend to do through our AIF platforms, Kotak Optimus or Iconic, is to create comprehensive investment solutions where the entire investment journey for the investors can be crunched and more efficiently executed on their behalf, where we intend to stick to the defined mandates and the investment policy of the strategies. Basically, what we're trying to achieve through Iconic and Optimus is our intent is to help optimize an investor's time, cost, and return while offering a smooth investment journey. Across the platforms, we manage close to 6,000 crores with a trust of 1,500 investors. If I look at in terms of the recent market, yes, it was a difficult quarter. In fact, I will characterize Jan, Feb, March quarter as a story of two halves, where after a brief kind of a sideways movement, which we saw in the later half of last calendar year, there were sharp movements, which the month of Jan, Feb, and March brought out. So Jan and Feb was typically characterized by very sharp downward move, which was less reflected in, let's say, the Nifty 50 index, but the broader market had a much, much sharper impact. So if you look at in terms of the broader market impact, a lot higher in terms of what Nifty 50 possibly have reflected. That was one period where we saw a lot of stocks correct more than 25%. So almost half of Nifty 500 universe would have corrected 20 to 25% in this period. March saw very sharp, surprising pullback. So a lot of funds which would have probably done better in Jan Feb by having higher cash allocation missed out in the bounce back of March, and it was vice versa. Funds largely fully deployed had a larger impact in Jan and Feb, but in the month of March also they had a sharper pullback. So it was a slightly difficult quarter to navigate. If I look at in terms of the overall breadth of the market also, it was extremely negative, with almost 70-80% of the stocks correcting more than the broader indices. Iconic Fund, in line with what the markets went through, also had a challenging quarter, where the fund had an impact in line with the market, which also corrected. So if I look at in terms of the fund, yes, a challenging quarter. This is the only quarter over the last 7 quarters since the life of the fund where we have underperformed the benchmark. Otherwise, all 6 previous quarters, you were able to outperform. If to look at in terms of what the impact on the fund has been, if I compare various strategies on the discretionary side, on the left side bottom table, we were more or less in line with the broader market or the peer average. So typically the endeavor in this quarter was not to take extreme calls, either being overly defensive or being overly aggressive. There were adjustments made in the strategy. Typically, these kind of phases, when they are not too sure in terms of what's happening, which is extremely news flow driven, the better approach what we adopted was see how you can minimize the impact on the portfolio, which reflected in terms of the impact on the portfolio across either Optimus or Iconic funds, being more or less in line with the peer averages or how the broader market panned out. So Iconic 1 and 2 performance over the last 3-6 months. Iconic 1, in spite of having a bad quarter, on a consistent basis, continues to have an outperformance over the benchmark. The strategies on the Optimus side fared slightly better, where the fixed income component did much better as compared to the benchmarks. The allocation on the equity side, as we will cover later, was also maintained lower than the strategic allocation. So let's say the moderate strategy was lesser deployed than 50% strategic allocation, and the aggressive strategy had lesser equity than the 80% strategic allocation, which to an extent helped minimize some impact on the portfolio relatively. But this has been in line what the entire market went through. So if we look at, let's say, for just as an analogy, the broader universe, typically these sharp movement phases where the markets have these very sharp drawdowns, active strategies typically have periods where they will underperform the benchmark on a short-term basis, which is also reflecting if we, let's say, just as a analogy, use the mutual fund universe, where on a 3-month period, hardly any negligible number of managers would have been able to outperform. So the impact was across the market. The impact was across various active strategies. The impact was across the peer set, which is also reflecting in a broader universe. There was hardly any manager, even in the mutual fund side or the PMS side, which over this 3-month period would have been able to outperform the benchmark. On Kotak Discretionary, our philosophy remains where we want to crunch the entire investment journey. So the Kotak fund management team from time to time keeps looking at the market, forms opinion in terms of what adjustments you make in the portfolio, which advisor to have, how much allocation to give. And once an advisor is chosen on the strategy, the allocations are managed by them in terms of the stock selection and sectoral allocation. This was managed in terms of the allocation across the last quarter as well. Typically, in our strategies, they use a combination of the smart beta strategies to play the large cap portion of the equity market and a combination of 3-5 active advisors to play the multi cap or the mid cap portion of the market. What we are able to do through this is, like for example, in Iconic, this is typically what the fund behavior is, what we've tried to map out over a market cycle. This is what the fund is likely to behave. So let's say there are different phases in the market. In an upward phase, the orientation of the strategy is to try and capture the upside as much as possible. So from a fund style perspective, positioning perspective, Iconic is designed and managed more like to focus more on the upside capture much better. The objective will be that in a range bound, when typically market will be in a range of, let's say, 10% up or down, the objective will be how you can absorb the impact, not take too much undue risk, and see how you can be closer to the benchmark in this period. But typically, very sharp drawdown periods, as we have seen in the month of Jan and Feb especially, when the broader market has a much larger impact, most active strategies will have an impact which is more than the benchmark, but these are short-term periods where the objective will be how you can minimize the impact on the portfolio by taking some corrective measures. But yes, these will be periods where, as compared to a, let's say, broader benchmark, most active strategies, including Iconic, will have a slightly more impact. Over this journey, the fund has navigated in different manners. So if I look at the period till around September of 24, since the fund started, that was the upward phase of the market for Iconic, where we did much better than the benchmark. So we generated almost a 9% alpha as compared to the benchmark. More importantly, the volatility of the fund was lower than the benchmark. So we had a far better risk-adjusted return during this period. The second phase, which is a range bound phase, where typically you could be a few percentage points up or down than the benchmark. In this phase, the fund did much better again than the benchmark. So between September till December was one period where the fund again was able to outperform. So two of these phases, typically which the market will go through over a market cycle, the fund held up very well. But yes, the month of Jan and Feb, where the broader market had a far larger impact, even the fund, as we have seen, most active strategies will underperform in this period, had a bit of an impact, but we were able to manage that. So if I look at across a broader universe, the performance was in the middle, where we were neither too aggressive or too defensive. But also, thing is that as a philosophy, we never take very active cash calls. We believe the money coming into the fund is meant to be deployed. So we largely remain fully deployed on the equity side. So typically in these phases, a few funds which will load up cash will possibly find it much better. But as we saw, the Jan to March quarter was a story of two halves. In the month of March, when the market surprised by very sharp pullback, having a very high cash allocation can also completely go against you. And the rally has continued in the month of April as well. So that's why the philosophy, what we have maintained is we will take those corrective actions through the strategy adjustments, but by not building in very, very high cash allocations for these market periods, which is a normal behavior for the market, where they can go through some periods of normal volatility. So the important takeaway here is that the strategy has been in line with the peer set average. There has been not been a much larger impact as compared to the peer set. We have been able to be more or less equal to what the peer sets have gone through. So through Iconic, what we're trying to achieve is that instead of having so many separate funds managed by the investors, how that can be a lot more simpler platform. What it also solves for investors is that in one strategy, the allocations can be dynamically managed, which will showcase that what are the adjustments which happened in the strategy to ride through this period, and what are the benefits investors can draw from this. So typically, Iconic is designed to navigate these kind of market phases, where as we just saw that two of these phases, the fund did much, much better. Even in a range-bound phase, there was an alpha which the fund generated. In a downward phase, we have been able to ensure that the impact on the portfolio, in spite of remaining fully deployed, has been in line with the peer set. The adjustments that were made in the Iconic strategy, so we increased the passive side of the portfolio. So typically to ride through different phases of the market, the fund as a framework will say whether we want to add risk to the portfolio if we believe that the markets could be poised for an uptick or we are playing for an upside. At the same time, if the framework indicates that at this point of a time, the market looks stretched or you want to adopt a more risk-off method, the allocation to the passive side of the portfolio gets increased. As we see, the fund had increased allocation to the passive side of the portfolio. More importantly, more defensive strategies, like for example, the low vol strategy, which from the lowest weighted strategy became the highest weighted strategy over a period of time. This helped us ensure that we were not having a much larger impact as compared to the CPS set, but were able to contain that without having any large cash positions in the portfolio. We continue to monitor this. We continue to deploy or change the allocations as the market situation changes. So in the month of April, there have been few more changes done to this. But yeah, the strategy remains that nimbleness, that as the market situation evolves, the allocations will change and align to the market situation. Moving on to the Optimus Fund. Across aggressive strategy and Optimus, the mandate remains 80-20 on the aggressive strategy, 80% equity, 20% fixed income. Moderate strategy, the mandate is 50% equity, 50% fixed income. There have been a few changes which the strategies have gone through in the Jan to March quarter of 2025. In the month of March, early part of March, there was a rebalancing that happened in favor of increasing equity portion in the portfolio. To an extent, that timing helped us, and the framework was able to highlight that rebalancing at the right point of a time. So between 22,100 on Nifty to 22,700, we were able to increase the equity portion. There was also one more change done in terms of the advisor portion, where ASK as an advisor was replaced, and that position was occupied by two other advisors, ValueQuest and Abacus. So now the equity portion of the Optimus funds is replicating the equity portion of the iconic fund. On the fixed income side of the portfolio, we were able to build up duration at the right point of time. So typically we had maintained the modified duration of the fixed income portion much closer to 2 years, which was increased to above 4 years across the funds. We will go through that in a lot more detail, but that has helped us as the yields have moved lower over the last 20-25 days. We also added one InvIT to the fund, the Capital Infra InvIT. There was an anchor allocation position that we picked up in this one. There was further addition that we were able to do in the QIB book as well. Incidentally, in this one, we got it at 11.9% yield. Plus, there has been a DPU payout of 12.7%, which has already been received in the last quarter. The rebalancing in the fund has worked out to the benefit of the overall strategy, where initially in the month of June to August, the first rebalancing was done to reduce equity. So the equity portion in both moderate and aggressive. So in moderate, it was almost 56%, aggressive was almost 86% was brought down to the strategic allocation. Incidentally, from September 24 onwards is when the market peaked out. Market started heading lower. When the larger bit of correction happened in the month of Jan and Feb, in both the strategies of Optimus, aggressive and moderate, the equity portion was much lower than the strategic allocation, which helped contain the impact on the overall fund. In fact, the framework again indicated, which we acted upon in terms of the equity being moved up. So around early part of March, the equity was also increased. So the increase in equity happened somewhere between 20,100 to 22,700 levels, which has also benefited in terms of the recent uptick which has happened in the market. On the fixed income side of the portfolio, there are quite a few changes which I've been going through in line with as the market situations have evolved. The REIT InvIT portion is something which we continue to monitor and keep adding different positions. So Capital Infra InvIT is something which we added to the portfolio. In addition, we considerably added on the duration side. So from almost two years of modified duration, the duration has been increased to 4 years or even higher, depending on different strategies, which incidentally has also benefited. Like if I look at on the yield side, the 30-year GSEC is typically what we've added to the portfolio, which has also moved lower by 18-20 basis points since the addition to the portfolios. This has got to do with the improvements that we are seeing on the fixed income side of the market, where the liquidity has become surplus. There was a very, very elongated period where the liquidity in the market was in a deficit. In line with the measures taken by RBI to improve that, we added to the positions on the duration side. We have also seen money come in terms of the buying from the foreign investors on Indian debt, which has enabled the yields to come lower. On the REIT and InvIT side of the portfolio, from time to time, we keep evaluating that what should be the best allocations to have in the fixed income or the alternate side of the portfolio. So there's always a relative comparison in terms of what is the best post-tax yield available in the market. So there, if you look at in terms of some of these medium-term, short-term bonds available, so from a post-tax perspective, the yields don't look so attractive as compared to the REITs or InvITs that we have in the portfolio. So from a relative perspective, that's why over the last 7-8 quarters, the allocation on REIT InvIT strategically has been moved higher. From time to time, the adjustments might happen, but at this point of time, the view remains that we will largely have a combination of REIT and InvITs and duration play. We are not looking at any higher allocation on the credit side. Without taking undue credit risk, we are able to have a better outcome in terms of a combination of REIT InvIT and the duration side of the Optimus fixed income portfolios. Moving away a bit from what happened in the month of Jan to March, from a forward-looking perspective, how the strategies are going to navigate and how the positioning is. To go into that, let's understand a bit on the macro position. So around mid-March, we had also sent across a detailed note in terms of our reading on the macro picture to the investors, where we had highlighted that in spite of the correction which the market saw in the month of Jan and Feb, Why we did not overreact in any of the strategies to become overly defensive? Because what we believe that from a fundamental perspective, there were improvements that we could foresee, or we believe that the markets were having a bit of a dip because the economy was going through a cyclical downturn. Our view remained that this is a cyclical downturn and not a structural issue. Uh, our reading came from the fact that if you look at various parameters, so let's say from a capex perspective, the initial part of last fiscal year had seen a slowdown because we had general elections in the first half of the last fiscal year, which impacted the spending from the government side. But come October, November, we could see that momentum come back, which was going to reflect in the numbers. If you look at on the other side, RBI had started acting in terms of various measures. The deficit liquidity situation was also slowing down the economic activity, but RBI started taking a set of measures. It has been backed by rate cuts also that we have seen in the in the economy. If you look at in terms of the fiscal deficit side, there's a bit of a consolidation that we have seen, but the glide path going forward from the government side is much uh, smaller now. So there's enough available from the government side to ensure that they can keep their side of the push in the economy going. Apart from that, rupee has remained largely stable. So there was a brief period when the dollar index moved up to around $108, 108 as well. But after that, we have seen dollar pull back. A combination of all of this, we were always looking at this more like a cyclical issue than a structural issue, which is reflected in the way the markets have behaved in the month of March and April. Inflation has continued to be under control. We are not seeing any inflation shock in the economy. Our comfort also remains that the financial system remains in good health, where either we look at from a capital adequacy perspective, or if we look at in terms of the strength of the corporate balance sheets, where the debt to equity ratios is well contained. We believe that from a more structural perspective, the health of the financial system is very important, which remains quite robust at this point of a time. This is a summary of the overall framework that we keep looking at to analyze what different positions we should look at across a fund. So across 6 broader heads, we look at various outcomes to say whether we want to be more risk on or risk off in any of the strategies. On all of this, what we have seen is that over the last 3 to 4 months, there have been gradual improvements. There have not been any deteriorations. So a bit that we covered in terms of the macro fundamentals, we remain confident that the macro fundamentals are for the Indian economy continue to be relatively much better. The domestic balance sheets, either in terms of the government balance sheet or the banking system balance sheet or the consumer balance sheet or the corporate balance sheet remains quite robust. There is no visible stress there. Valuations have got better. Yes, at one point of time, the valuations were looking slightly elevated, but the recent correction has offset a lot of that. On this, we will cover a little more in detail because valuations are a very important parameter when any investment decision is being made. From a flow perspective, the domestic flows always remained robust in terms of the Indian equity markets. There was a slight negative view in terms of the FPI money coming in, but that also looks to be reversing. Over the last couple of weeks, we have seen decent amount of participation come in from the foreign investors as well. The liquidity side, as we saw, there have been measures taken by the central bank which have ensured that the liquidity situation becomes available. So there's enough comfort coming across on the economy side. The external situation remains a slight mixed bag. We are still not too sure in terms of how the trade war issue would play out. So that's why we are not building any extreme position based on the external view. But as a net aggregate outcome of all of these parameters, it gives us a comfort that gradually over a period of time, the funds have maintained a more defensive position, as we saw, for example, in the case of iconic equity side, where the passive allocation was increased. Very likely over the next couple of months, we might see more risk added back to the fund. Our view remains that we will rather look to add more risk rather become more defensive. Uh, that's what we gradually have been looking to do on the fund strategy side. So from a forward-looking perspective, we are not looking to become more conservative. In fact, if any adjustments happen, they are more likely to happen in terms of adding risk on more back on the equity side of the portfolio to play more from the pickup on the equity market side. In terms of the valuations, there if you look at in terms of different parameters like price to earnings or price to book, the Indian markets are looking a lot better now. In fact, if I look at on last 10 years averages, the market valuations are below the last 10-year average now, which means that the markets are not expensive. We might say the markets are not very cheap as well, but we are definitely not expensive. We are in a fair value zone. Whenever the markets are at these levels, unless there's an external shock or a domestic shock, the market ideally should not have a larger correction. If I look at in terms of across other parameters, this is on forward earnings. Again, the same picture where the large cap valuations look a lot more reasonable. We are a lot more closer to the last 10 years average. Again, the markets are not looking expensive. The middle small caps after the correction, which they have also seen, the richness in the valuations also got corrected to a very large extent. They are still trading at a slight premium to large caps, but no reason for us to believe that the mid and small caps could have a larger fall from here. Large cap, mid cap, small cap more or less look like in a slight equal zone at this point of a time. More importantly, if we look at India versus the global peers, on the left side, if we compare India's relative valuation to the MSCI index overall, we are now at or slightly lower than the long-term average premium that we have traded at. So we had at this point of a time trading at almost just a 5% premium. We have historically traded at much higher levels. So from a relative valuation perspective, we are much better off. If I look at India's premium, which is reflected on the right side versus other emerging markets, there also we have a substantial correction. We are trading at our historical average premiums in spite of our fundamentals being a lot better. Same situation when we look at it in terms of the price to book ratio. In fact, on price to book, on both the parameters, India looks a lot more attractive against historical average versus the world markets or the emerging markets. So valuation looks reasonable at this point of a time. From a fundamental perspective, India remains relatively better off. That gives us a comfort that we should not look to take more defensive allocations. In fact, at the opportune time, the next change, if at all likely on the portfolio, is more likely to be add more risk to play the upside better rather than become more defensive. Our comfort also comes from historical analysis. When we look at different calendar years, typically a 15% movement in equity market is something which we foresee almost every second year. So that's the nature of the asset class. Over the last 25 years, if we look at almost 60-70% of the years would have seen a 15% movement in the equity markets happen on a yearly basis. More important thing is that whenever these kind of corrections happen, what have the markets delivered on a forward-looking perspective? So if you focus in terms of the table on the left, on the bottom side, typically when the markets correct, after that 15% fall, the median returns have been almost 20 to 18% on an average. So typically, these are periods when if the investors can fathom the volatility, understand that these are cyclical issues, not structural ones, there are better returns to be made. Our comfort at this point of time also stems from the fact that those periods when the markets, after correcting 15%, have corrected even higher, have been instances driven by crisis. Either it was the dot-com crisis in 2020 or the global financial crisis almost 16 years back in 2008. At this point of a time, very likely we are in a cyclical downturn. It's not likely to be a crisis situation. Yes, the global tariff issue remains an overhang we continue to monitor, but the base case reading remains that we are not likely to see a crisis kind of a situation emerge out of this. Yeah. So that's what we have wanted to share in terms of what the strategies have gone through, how we have been able to navigate, and from a forward-looking perspective, what is our reading on the market and how the strategies are likely to be positioned. We'll now open it up for question and answers. You can put all your questions in the chat box. In the chat box. Going back to a little in terms of what the quarter of Jan, Feb, and March saw for the equity side of all the strategies, especially Iconic. Going into the quarter of Jan, there was adjustments made in terms of the strategy becoming risk off, where we had increased the allocation to the low vol strategy substantially in the portfolio. And that is one strategy which performed much better during that month. So if you look at, for example, the strategy on the low vol from 8% became almost 20% of the portfolio, due to which what we were able to achieve is that in spite of not having large cash positions built up, which we maintain as a philosophy that we will remain fully deployed, the impact in the portfolio was in line with the broader market. So if you look at in terms of Jan to March, the broader market correction was much, much higher, where if you look at, let's say, Nifty 500 equal weight index, which will give a true indication of the broader market impact, Nifty 500 equal weight index corrected almost 11% for the quarter. The Optimus and Iconic strategies impact was much lower. It was in single digits. The impact on the portfolio was also much closer to the peer average. So typically what we will maintain is these are not periods where you would want to chase alpha. These are periods when you say, let us be not either too aggressive in terms of either being conservative or overreact on the other way around. These are periods where times you say, let us ride through with a minimum impact come through and then play for the upside. That's what the focus was in the month of Jan to March. Now we're gradually seeing how we can add some risk back to the portfolios. There is one more question in terms of any allocation in terms of the commodity side. So as a philosophy, Iconic or Optimus, we don't take any commodity allocation in these funds. So typically the mandate remains either completely equity for the Iconic fund or a combination of equity and fixed income on the Optimus strategies. So any alternate allocation that we look to take in terms of the Optimus fund also is restricted to REITs and InvITs. We don't take any commodity positions. So let's say gold for an example, that as a mandate of the fund is something which will not take. This will largely be between equity and fixed income, which will include REIT InvITs in the portfolio. Yeah. Any more questions? Would request investors to put in the chat box. I think there are no more questions. Hope to see all of you again in the next quarterly webinar. The fund continues to be actively monitored. We continue to adjust the allocations as and when desired in the portfolio. Thank you for the trust that you have placed in the Iconic and the Optimus funds. Hope to see you in the next quarterly webinar. Thank you.